Hey everyone, welcome back to Trek for Wealth, the podcast where we talk about money the way real people actually talk about money. I'm Avery.
And I'm Grant. And Avery, I want to start today with a confession.
Ooh, okay, go ahead.
I have no idea what the economy is going to do next.
That's your confession?
I know. Coming from the guy who's supposed to be the seasoned financial history voice on this podcast. But here's the thing. Nobody knows. Not the Fed, not Wall Street, not the economists who predicted the 2008 crash, or more accurately, the very few who did.
And we have spent 6 episodes talking about oil shocks, falling dollars, record gold prices, mortgage rates, AI disruption, and a 3-tiered E-shaped economy. And I think our listeners might be feeling a little bit overwhelmed.
Rightfully so. The world is genuinely complicated right now. And if you've been listening to Trek for Wealth and thinking, okay, but what do I actually do with all of this? Today's episode is the answer.
Because today, we're not predicting anything. We're preparing for everything.
Preparing without predicting. Let's get into it.
Okay, Grant, let's start with the honest truth about predictions, because I think people need to hear this before we talk about strategy.
So here's what decades of financial history actually show us. Professional forecasters, the ones with Bloomberg terminals and PhDs and research teams, are wrong about major market moves more often than they are right. A major study found that economists predicted exactly 0 of the last 10 recessions until they were already happening.
0 out of 10.
0. And it gets more humbling. In 2008, the biggest financial crisis since the Great Depression, the majority of Wall Street analysts were still issuing buy recommendations on financial stocks in September of that year, after Lehman Brothers had already collapsed.
After Lehman collapsed, they were still saying buy?
Still saying buy. And in 2020, when COVID hit and markets dropped 34% in 33 days, the fastest crash in history, not a single major bank had predicted it. Not one. A month before it happened, the consensus forecast for 2020 was continued moderate growth.
So the smartest, best resourced people in finance consistently failed to predict major events.
Consistently. And here's the really important implication of that. If the professionals can't predict it, you definitely can't predict it. And more importantly, you don't need to predict it because there's a better approach entirely.
Which brings us to a man named Ray Dalio.
Ray Dalio, founder of Bridgewater Associates, the world's largest hedge fund, and someone who spent decades thinking about exactly this problem. How do you build a portfolio that doesn't require you to be right about the future?
Tell us about Dalio, because I think a lot of our listeners have heard the name, but maybe don't know the full story.
So, Ray Dalio started Bridgewater out of his 2-bedroom apartment in New York City in 1975, and he built it into a firm managing $150 billion at its peak. But what makes him interesting isn't just the money. It's a lesson he learned the hard way very early in his career.
What happened?
In 1982, Dalio made a very confident prediction. He believed Mexico was about to default on its debt, triggering a global economic depression. He was so confident he went on television and said so publicly. He put his own money and his clients' money behind this prediction.
And was he right?
Grant did default, and there was a debt crisis. But instead of a depression, the Fed stepped in, cut rates, and the stock market had one of its biggest bull runs in history. Dalio was spectacularly wrong. He lost so much money, he had to let go of all his employees. He had to borrow $4,000 from his father just to pay his bills.
Well,
And instead of being destroyed by that experience, he became obsessed with one question. How do you build a portfolio that doesn't depend on being right, that can survive any outcome, boom, bust, inflation, deflation, without requiring you to predict which one is coming?
and the answer was the all-weather portfolio.
The all-weather portfolio, one of the most important ideas in personal investing of the last 50 years.
Okay, explain it. Because the name is perfect, all-weather. What does that actually mean in practice?
So Dalio's insight was this. At any given moment, the economy is in one of 4 environments: growing faster than expected, growing slower than expected, inflation rising faster than expected, inflation falling faster than expected. And here's the key. Different assets perform well in each of those environments.
So, stocks love growth, bonds love low inflation, gold loves uncertainty and rising inflation.
Exactly. Stocks do well when growth is strong. Long-term bonds do well when growth is weak and inflation is falling. Gold and commodities do well when inflation is rising. And Treasury inflation-protected securities, TIPS, do well when inflation surprises to the upside. The problem with most people's portfolios is they're essentially betting on one environment, usually strong growth, which means
When the environment changes, they get crushed.
crushed. A typical 60-40 portfolio, 60% stocks, 40% bonds, sounds diversified, but it's really not. Stocks are so much more volatile than bonds that in a market crash, the stocks dominate everything. During 2008, a 60-40 portfolio lost about 30%. That doesn't feel like diversification when you're living through it.
So, Dalio's idea is to spread your risk across all four economic environments, not just the one you think is most likely.
And you don't have to predict which environment is coming. You just need to be ready for all of them simultaneously. Hence, all weather.
So, what does the actual portfolio look like?
So, Dalio shared a simplified version of the all-weather approach in an interview with Tony Robbins, and it's beautifully simple. 30% in U.S. stocks, capturing growth in expansion environments, 40% in long-term U.S. Treasury bonds, performing well in recessions and deflation, 15% in intermediate Treasury bonds, a stability buffer, 7.5% in gold, inflation and crisis protection, and 7.5% in commodities, additional inflation hedge.
So, it's not just stocks and bonds, it includes gold, which we talked about in episode 4, and commodities.
And notice how small the stock allocation is, only 30%. Most people are shocked by that. But remember, stocks are roughly 3 times more volatile than bonds, so to make the risk of stocks equal to the risk of bonds, you need a much smaller allocation to stocks and a much larger allocation to bonds. You're balancing risk, not dollars.
And how has this actually performed historically?
During the 2008 financial crisis, when equity-heavy portfolios lost 40 to 50%, the all-weather approach experienced significantly smaller losses because bonds and gold offset the equity decline. It won't win every year. In a raging bull market, a pure stock portfolio will beat it. The S&P 500 has outperformed all-weather in recent years. But here's the question Dalio always asks. Do you know when the bull market ends?
Nobody does.
Nobody does, and the all-weather investor doesn't need to know because they're prepared either way.
Preparing without predicting.
Preparing without predicting.
Okay, I love the philosophy, but let's get really practical because I know our listeners are thinking, how do I actually build this? I'm not a hedge fund. I have a 401k and maybe a brokerage account.
And the great news is you don't need to be Ray Dalio to apply this. You can build a simplified all-weather portfolio with just a handful of low-cost ETFs. Let me give you the building block.
Docs first.
For the stock portion, a simple S&P 500 index fund or a broad market ETF, ticker VTI or SPY. Broad, low-cost, instant diversification across hundreds of companies.
Bonds.
For long-term Treasury bonds, TLT, that's the iShares 20-plus year Treasury ETF. For intermediate bonds, IEF, the 7 to 10-year Treasury ETF. These are the ballast of the portfolio. When stocks fall in a recession, these tend to rise.
Gold. We covered this in episode 4. GLD or IAU.
DLD or IAU, both track the gold price directly. Remember, the 28% collectibles tax rate we mentioned, just keep that in mind for your tax plan.
And commodities?
A broad commodity ETF like DJP or PDBC gives you exposure to energy, agriculture, and industrial metals as a basket. This is your inflation hedge for when prices are rising across the board.
So theoretically, 5 ETFs and you have an all-weather portfolio.
5 ETFs, that's it. The hardest part isn't building it, it's maintaining it because you have to rebalance. Once a year, bring the allocations back to their targets. When stocks have a great year and become 50% of your portfolio, you sell some and buy more bonds and gold, which feels deeply counterintuitive.
You're selling the thing that's winning.
and buying the thing that's lagging, which is exactly what disciplined investing requires, and exactly what most people cannot bring themselves to do without a framework.
Okay, 3 wealth moves to close. But Grant, this whole episode is the wealth move, isn't it?
Really is, but let me make it concrete for different situations.
Move 1. If you are in your 20s or 30s and have a long time horizon, you don't need the full all-weather approach yet. Your time horizon is your all-weather protection. But take one lesson from Dalio. Diversify beyond US stocks. Add international exposure. Add a small bond allocation. Don't be 100% in US equities. History shows that even young investors who are heavily concentrated in one market can experience decade-long periods of flat returns.
Move 2, if you are in your 40s or 50s and starting to think seriously about protecting what you've built, the all-weather principles become essential. Start shifting your portfolio towards the balanced approach. Not overnight, gradually. Every year, rebalance towards a more weather-resistant allocation. The goal at this stage is to stop being vulnerable to any single economic outcome.
And move 3, and this is for everyone, regardless of age. Audit your portfolio right now for concentration risk. Open your brokerage account or 401k. Look at what you own. If more than 70% is in US stocks, you are essentially betting that the US bull market continues indefinitely. That's not a plan, that's a hope. And as Grant's story about Ray Dalio in 1982 shows, even the smartest, most confident investors can be spectacularly wrong.
Dalio's biggest lesson wasn't about a specific investment, it was about humility. He said that losing almost everything taught him that he needed to protect against being wrong as much as he needed to try to be right. That's the whole philosophy, not predicting the future, preparing for all possible futures.
And after 6 episodes of Trek for Wealth covering AI disruption, oil shocks, record gold prices, falling mortgage hopes, the E-shaped economy, and a weakening dollar, preparing for all possible futures feels like exactly the right approach.
Every single topic we've covered is another reason to not have all your eggs in one basket.
This is the episode that ties all 6 together.
It really is.
Grant closes out.
Ray Dalio once said, "He who lives by the crystal ball will eat shattered glass." Stop trying to predict the next crisis. Start building a portfolio that doesn't need you to. The all-weather investor doesn't win every year, but they're still in the game when everyone else is counting their losses.
Preparing without predicting. That's the move.
That's the move.
That's Trek for Wealth. Thank you so much for listening. If you've been with us since episode 1, this is the episode to share because it's the answer to the question every one of our previous episodes raised. What do I do about all of this? Now you know.
All sources in the show notes as always. The Dalio 1982 story is worth reading in full. We'll link to his book Principles in the show notes.
We'll see you next week. Keep trekking.
Take care, everyone.